All over the country, ground-up opportunity zone development projects are stuck. Oftentimes, the numbers just don't pencil. Spreads are too thin, capital's too costly, and equity demands are too high. But structuring preferred equity into an OZ deal could get them moving again. Welcome to the Opportunity Zones podcast. I'm Jimmy Atkinson. Ackman-Ziff has been at the forefront of the equity markets over the past 2 years. They've raised over $2 billion over that time period in programmatic equity for its sponsor clients at a time when, frankly, it's been pretty tough to do so. Today, I'm joined by two of Ackman-Ziff's executives, Jordan Brustein and Andrew Rudy. Jordan and Andrew lead the firm's Opportunity Zone equity practice and are currently in the market on over $1 billion of OZ financing opportunities. Gentlemen, great to have you here. Welcome to the show. How are you?
Thanks so much, Jimmy. Good to see you.
Thanks, Jimmy.
Yeah, good to see both of you as well. Appreciate you guys reaching out a few weeks ago and sharing that white paper with me on some creative OZ equity structuring that you're employing into some of the deals that you're advising on. We'll talk about that in a little more detail later in the show. But first, I wanted to get backgrounds on both of you. Jordan, curious if you can start us off, share your background with us. How did you get to where you are today?
Yeah, happy to. So I graduated in 2012 from the University of Michigan, began my career at Newmark, was fortunate enough to work on a top producing office leasing team there. And while working full time, I also pursued a master's in real estate finance at NYU Shack Institute and completed the program as part-time at night and transitioned from the office leasing side to the capital markets and came over to Ackman-Ziff. Been here for the past 8 years and focus on debt and equity placement across the country. In my first few years, I executed business for the senior partners and got to really hone in on my underwriting execution skills while working on pretty complex financings across all asset classes, all throughout the capital stack, all throughout the country. Worked with a wide range of sponsors from family offices to institutional developers. And from there, I really got to shift toward originating business, which is where my passion really lies. I generally enjoy building relationships, making connections, turning new introductions into lasting partnerships. So as you know, more than anyone in this business, it's 100% relationship driven. We pride ourselves not only on the strength of our sponsor relationships, but equally as important, our capital relationships. We travel extensively throughout the country. We develop and maintain these partnerships and make sure when we take on a deal, our capital relationships know it's been carefully vetted to fit within their specific parameters. And also what's unique about AZ is we operate as one true team. We're 45 individuals here, and we occupy a pretty specialized position within the capital markets. We pursue select opportunities, pivot to where there's emerging demand, and become experts in spaces where we see there's a need. So over the last couple of years, Andrew and I really come together and developed a strong relationship that's really built on just complementary skill sets and a shared approach to the business. So he comes from more of a private equity background where he really excels on all things deal structuring. While I enjoy that side of the business, I thrive on the personal side. So cultivate relationships and creating opportunities. So from that, yeah, I'll hand it over to Andrew.
Yeah, Andrew, it sounds like you have a complementary skill set with Jordan. What little background on you? How did you get to where you are right now?
Yeah, I appreciate it. I started my career with JLL in Los Angeles and was really fortunate to land a large client working for the largest non-for-profit healthcare system in the country, who often acted as their own developer. And so I did 150 deals for them from LA down to the border. We were buying dirt, we were doing build-to-suits. There was a lot of back office leasing for them as well. So I had a pretty broad-based transaction experience. Eventually, we bought some dirt from an operator that was based out of Southern California who was very overexposed with one capital partnership. And they brought me on to basically go out and be an acquisitions lead for deals that fell outside their existing capital partners buy box. And it really morphed itself into a role that was much more capital markets facing. And that, the main driver behind that acquisition activity was to source new equity partnerships for the firm to help diversify the investor base. And that's where I really learned that, like Jordan, we both like being spread thin. And I wasn't in love with any particular asset class that I was chasing. I was really more in love with being a student of the business and understanding how JVAs were negotiated and the interaction between JVAs and loan docs and operating agreements and major decisions, and equity waterfalls, yeah, more of a math guy, I guess you could say. So we eventually sold that business to a large non-traded REIT, and I moved back over to the advisory side here in New York with Ackman-Ziff, and have been here for almost 3 years. And Jordan and I have been really fortunate to be deep in the market, in the OZ equity space, and really thrilled to connect with you today and share a lot of what we've learned in the past 12 months, since we've really, as Jordan said, leaned into where there is liquidity.
Yeah, well, let's talk about opportunity zones now. Ackman-Ziff, capital advisor, but your firm has been leaning into opportunity zones more and more lately. Why is that? Why opportunity zones for Ackman-Ziff?
Well, as you know, Jimmy, real estate has always been, there's always been strong tax advantages, which is a big reason to attract so much capital. It stays more liquid than a lot of the other private markets because people jump in it, for the tax benefits. So OZs really supercharged that in a way no one really saw coming. When OZs came out, a lot of the big funds with access to wealthy investors jumped in fast and raised 10-year vehicles. The structure provided managers with a reliable fee stream, which is obviously attractive for any investment firm. And at the same time, a lot of managers who never really touched real estate started playing in the space. So on top of that, add in the bull run from 2016 to 22, and there's a lot of capital looking to be placed. So the key question then became, would developers accept this capital if it meant extending their hold periods and giving up a lot of promotes and upside in a typical 3 to 5 year period? And the answer has been yes. Since 2017, when the legislation passed the OZs, it's become a major contributor to the housing pipeline. I forgot where I saw it recently, but in 2023, I think 25% of all apartments under construction in the US were located within OZs. And that really allowed us to lean into the space. 100 billion has been deployed in the OZ since inception, and it's not going anywhere with the new OZ 2.0. So to date, it's been a strong concentration in urban markets. And while a lot of the QOFs lean heavily toward housing, there's been significant appetite for logistics, industrial, and other asset types. And with OZ 2.0 and becoming permanent in 2027, we're keeping a close eye on the fundraising. So there's been a lot of big institutional OZ funds that we've been speaking with that have, starting to set up the docs, and we expect a real pickup in 26 as they finish deploying their current commitments and get clarity on the new track maps. And I would say about 12 to 24 months ago, we worked on a deal in Boston, which I'll let Andrew touch on. And that's really leaned us to lean in heavily to the space. Back to my point earlier in the call, we lean in where we see opportunity, and through that exercise, we saw a lot of opportunity. So Andrew, I'll let you speak to it.
Well, just to interrupt for a second, just to kind of give a little bit more context and put a bow on what you said. Opportunity zones have really helped catalyze a lot of housing development and all forms of real estate development over the last several years since program inception. But at the same time, there have been some structuring challenges, right? In this new macroeconomic environment, capital's gotten more expensive, and it's led to the numbers just not penciling for a lot of OZ development deals all over the country. Spreads are too thin oftentimes. The capital's too expensive, I mentioned. Equity demands can be too high. I'm just kind of curious, how do you view the structuring challenge? And maybe you can talk about that Boston deal, Andrew, and what have been some solutions that you've helped develop?
Yeah, happy to speak to it. I mean, I think, as Jordan mentioned earlier, like, real estate's a long-term asset class. It should be. Unfortunately, the equity markets, as real estate has become exponentially more institutionalized in the last 2 decades, has been an IRR-driven asset class. And oftentimes when we're in a rising rate environment or an inflationary environment, that makes development incredibly hard to pencil. The 9 times out of 10, really 9.5 times out of 10 today, you can look at the math and slice and dice a development deal any which way, but in the last 24 months, there's probably very limited comps that would suggest that you could build that asset to a margin of safety below what Class A comps are trading for a developer to make a profit. In general, Class A deals are trading for below replacement costs. And if you have IRR-driven capital, you need the market growth to catch up rather quickly to make an argument that that you'll have a successful outcome from an IRR perspective in the next 3 to 5 years. If you take a much longer term approach in a lot of these markets that have seen a lot of supply in the last, call it 24 to 48 months, you can see that supply is tapering rather quickly, and you can take a 10-year horizon and say, well, I believe that NOI will CAGR on average 3% over the next 10 years, but it may be only 1 or 2% over the next 3 to 5. And you can really lean into a lot more growth into the back end of these hold periods. I think there's just a psychological, emotional effect to the long-term nature of the OZ capital that allows them to price or underwrite assets in that manner. Still, though, a lot of these asset managers and investment managers that have raised OZ equity, they have other equity vehicles that are non-OZ that aren't doing development today. And so for them, it's probably the same investment committee, right? For that investment committee to say yes to a common equity structure for an OZ development just simply because the capital is OZ in nature, when they're not doing it in other parts of their firm's capital efforts, it's difficult. And so in really the last 12 months, call it major 15 OZ funds across the country all started developing their own internal kind of creative structure that puts them into a somewhat preferred place in the capital stack, even though it is a long-term hold asset. And that structure has, one, really just piqued our interest, and two, we think has become more accretive than the other preferred equity structures that are being offered in the market that are non-OZ related. In general, you really can't stomach having capital in your stack that is equity that is preferred to your common equity for an entire 10 years. But the way these OZ funds have done it is such that we're really calling it structured common equity, where they do have some priority positions, maybe at a sale event, maybe some priority from a refinance event. But the beautiful thing is, A, the overall cost of capital is, call it 200 to 300 basis points cheaper than your standard merchant build pref, but it also doesn't need to be paid off at capital events that happen prior to the sale. And so you're allowed to significantly reduce that quote unquote expensive capital in the stack, but it stays in the stack with you for 10 years, and your common equity continues to get distributions throughout the entirety of the 10-year hold. So the IRR is not 100% driven by a sale event to your common equity holders. And that has allowed for a risk-adjusted return to that common equity look a lot better than if you were to take on non-OZ pref for a merchant built development. So I'm happy to walk through, Jimmy, like a bunch of different ways to look and slice and dice the math. But the gist of it is that it's really just structured like common equity throughout the entirety of the hold, such that you can go pari and pro rata on distributions with your OZ preferred equity partner to have an equal IRR to that OZ preferred equity partner prior to the sale event. And then at the sale event, you'll prioritize a distribution to them on the back end. There's different ways to slice and dice that, but that's the gist of it.
And a minute ago, Jordan made a reference to a example of a Boston deal. Do you want to walk us through that? And yeah, that's an example of how this actually works in the real world, right?
Sure. So yeah, let's do some real numbers then. And I'll use back of the napkin math. That deal was about $100 million of total stack, 235 units. And we were building to roughly $6 million of NOI, so 6% return on cost, which is roughly the math that a lot of deals in the market see today. If you're financing that asset on the debt side, 4 years ago, construction lenders were sizing to like 8 debt yields. So 6 million divided by 0.08 is $75 million of construction debt. Today, construction lenders are sizing that to a 10 debt yield, but your permanent financing takeout from the agencies is around an 8.25 debt yield. Let's just say that all-in rates are in the low fives and you have a 30-year AM and a 125x cover. And so if I'm financing at a 10 debt yield on the construction side, and I have $60 million of construction financing, that's 60 LTC, there's $40 million of equity remaining to fill that stack. We were getting term sheets from, call it 7 of the top 10 OZ funds on that deal all with varying structures, but getting up to around 80% of cost. So they were going to attach their dollar at that $60 million construction loan and get up to 80 million of cost. So they were going to write us a $20 million OZ preferred equity check. And the rough math was that capital priced at around 12, 13% money. And if it was not OZ money, it probably would have priced at around 15 to 16% money based off of that NOI math that I walked through. The beautiful thing was, if I didn't even trend rents at all and just say, let's say that $6 million of NOI remains at $6 million of NOI for the next 3 years. And when we finish this asset, we put permanent financing on the asset. We were going to accrue that OZ preferred capital count of $20 million by that 12 to 13% compounding. They were going to accrue in those first 3 to 4 years, so roughly $27.5 million. But like I said, we have Fannie Freddie debt that we can get that's at around an 8 debt yield at a 5.25% interest rate and a 125x cover. That's going to get us $75 million of agency debt when we perm that asset. So we're going to pay off the $60 million construction loan and have around $15 million to distribute to the capital partners. Well, my OZ institutional partner is putting in 20 million. My developer, my client, the sponsor, they're going to put in 20 million. And when we get to that perm, that 20 million is accrued to 27.5. But each capital partner, the developer and the OZ institutional partner, each put in 50% of the required equity. One put in 20 that's in a senior position, the other put in 20 as common equity. That $15 million cash out, the $75 million of agency debt that I got minus the $60 million of construction debt that we're paying off, is going to be split pari passu and pro rata to those equity partners. So I just gave my institutional OZ equity partner a check for $7.5 million, and they accrued from 20 to 27.5. So now here I am at really the end of year 3 or the beginning of year 4, and my OZ equity partner has a capital account that is probably equal to, or hopefully less than, if rents grow at all, their initial equity contribution in the deal. And now on the back end, to pay them off at a 12 or 13 IRR, because I'm cash flowing and offsetting some of that accrual with, again, a split of 50% of the available distributions made to the equity partners after senior debt service, that OZ equity, their capital count may only be $25, $26 million. So someone wrote me a check for $20 million. I then gave them 7.5 at the perm. And I also got 7.5 at the perm. Then we split every distribution from operations 50-50. And then on the back end, I only owe them like $25, $27 million. And if I just CAGR those rents by 3% and I sell at a 5 exit cap, I'm selling that asset for $180 million or so. And I only have $75 million of agency perm debt to pay off. So let's just use round math here. But now I have $100 million left or so to distribute to the equity partners. And I only owe the OZ equity partner that gave me a $20 million check at time 0, $25 million. So there's $75 million left to distribute to the common equity. And I know that's a lot of math, but the very, very, very basic math is, if I have a $100 million deal and I built the $6 million of NOI and I don't layer in any of these OZ pref structures, and I just have $60 million of construction debt and $40 million of equity, and I CAGR those rents by 3% and I sell at a 5, that's roughly a 3x over 10 years. I'm paying that OZ equity partner like a 2. So my common equity ends up getting a 4x. So you get about a 25% juice to your equity multiple on the back end of your common equity. There is a significant amount of positive leverage that is created via the ability to, at perm, reduce that capital partner's capital account that has accrued. And we have found that to be successful not only for ground up development deals, but both pre and actually, believe it or not, post CO deals for deals that may be over levered and need new OZ equity to help pay down debt. And we're currently out in the market on a handful of both. And that's been really accretive to sponsor clients who probably can't stomach more expensive non-OZ merchant built pref.
And on the development side, you get 2 bites of the apple, which I think is the appealing part. You have the refi, and then you also have the sale, as opposed to the merchant builds where you have to hope everything is good in 3 years. I do think it's worth noting, though, a couple of the challenges on this front. Although we think it's super accretive, it still requires a large amount of syndicated equity, right? They're only getting up to 80, 85% of total costs on these developments. So sponsors bringing more to the table. and then also cost overruns as well, where it's on the sponsor. So those are probably the two that come to mind on that front.
Yeah. So this structure, you referred to it as preferred equity, but it's not true preferred equity. It's more structured common is what you referred to it as, if I recall correctly. Is this juicing an already good looking deal, or is it rescuing deals that don't pencil? What does a typical merchant build math look like, and has it broken down over the last few years? And this is addressing that problem, but maybe I guess we have the solution, right? I'm asking you to characterize what the problem that this solution is addressing.
It's a good question. I think that again, just going back to the long-term nature of how real estate is supposed to be invested into, it's not that any deal is broken or is a good deal. In reality, we don't know, right? It's development. You never know. You put shovels in the ground. Hopefully you complete on time and on budget, and hopefully during that 24 months, rents grow a bit and interest rates come down. But we don't know. What we do know is that, as Jordan said, you get 2 bites at the apple. So if rents are flat and interest rates are flat, and you end up having a kind of weak permanent refinancing, you get another 6 years to let NOI build and cap rates come down again. And in a lot of these markets, especially some of these gateway markets that have much more liquidity and stability over the long term, we expect that asset values will catch up. And so if I take on pref for a deal that has a 3 to 4 year hold horizon, that rate environment and that supply environment better be good 3 years from now. But over 10 years, things should kind of even out. And so I think where we are seeing it rescue troubled deals is actually on post-CO deals. Because like I said, 4 years ago, the math was quite different. Construction lenders were sizing to 8 debt yields, not 10 debt yields. And so you were automatically on day one over-levered in comparison to where today's permanent financing environment is. And on top of that, in a lot of these markets, you've had a ton of supply because there was liquidity for development from 2020 to 2023. And those deals maybe have had some negative rent growth. And so they are over-levered from their construction loan ability to pay off the construction loan with permanent financing. Those deals are great candidates for a post-CO OZ recap because we're able to get new OZ capital to invest into the existing qualified opportunity zone entity that's in the deal that is hopefully compliant and followed all the safe harbor working capital guidelines and substantial improvement guidelines, et cetera, et cetera. And while you'll have to restart a 10-year clock for that asset, same thing. That preferred equity is even cheaper, honestly, than the call it pref behind agency market.
And we view it as an insurance policy.
Exactly. It's an insurance policy such that when you do go to perm out that asset, you don't have to pay off the pref at the moment of perm. You can leave it in. We're even working with some of these OZ funds who, like I mentioned earlier, have variety buckets of capital, and many times actually add a tremendous amount of value by being in the stack at the time of perm. Some of them are very large Fannie Freddie borrowers, and so they get 20 to 40 to 50 basis point spread reductions just by them being in the stack. And so that's really where we're saving deals, is just this ultra cheap pref from the OZ funds who don't need to take development risk. A lot of that capital is like Jordan said, wanting to go out the door today because these funds want to get their commitments out, get paid the fees on them, and then start raising for OZ 2.0 in the latter half of 2026. And so we're spending a tremendous amount of time on those types of opportunities.
And that's why you're also not seeing common equity going out the door today for ground up development when you have all these types of opportunities in the market with less risk.
And you mentioned bringing in OZ capital into a post-CO deal.
That's right.
Post-CO meaning after the asset receives its certificate of occupancy and can start being put into service, essentially. Is that OZ capital allowed to participate in the tax incentive, though, or does it need to be pre-CO? How does that work?
It's unbelievable. We're almost nervous to mention it on the podcast because it's kind of our own little secret in a sense. It is unbelievable, but you can participate in the tax benefits. The rule of thumb is as long as the existing OZ entity in that deal is OZ compliant from a tax perspective, and that, like I said earlier, it followed all the safe harbor working capital rules and it received substantial improvement. It does not matter when that OZ entity was created or when that asset was placed in service. New OZ equity can come into that entity at any time, as long as the uses of capital are to delever. So you cannot have a disguised sale. If there is equity that is repatriated to that entity existing equity investors, then that is that's a trip up. That's a fault line. So that's where we're really, really careful about sizing these deals. And to be honest, what's really incredible is because OZ equity was raised for mostly development risk. There are some fund vehicles out there that are focused on pre-TCO acquisition opportunities with very limited development risk. But we are seeing a lot of capital that is now understanding this post-CO stuff really chase this because it is no development risk. It is, and they are pricing the capital so cheap. And so they're getting up to almost 95, 100% of value on some of these deals when on their last dollar risk, when they're coming into the stack to quote unquote rescue and delever.
And it's saving sponsors. I mean, this is a cash neutral solution for them to stay in the deal long term.
That's right.
Yeah, very interesting. So shifting gears a little bit, can you characterize how you view the market currently, and what does your pipeline look like currently as well?
Yeah, I mean, we're currently engaged in the market, closing on more than $1 billion worth of OZ capitalizations nationwide. That's both debt and equity. These deals span from core markets such as Seattle, Phoenix, Boston, Brooklyn, Miami, DC. We're in closing on deal in a couple of emerging markets, Provo, Colorado Springs. And we're pretty agnostic regarding the market. It's really knowing the capital. And the profile of deals range from ground up construction, mid construction, and post CO, as we just alluded to delever the expensive capital stack. So, we continue to deepen the relationships across the space, from groups like yours to senior executives at Novogradac to leading attorneys at firms such as Greenberg Traurig. So, business can get as technical as you want, but our approach, we try to keep it simple. It's educating sponsors on the complexities of structuring while maintaining strong capital relationships. So when we bring in a deal to market, investors know the sponsor is prepared and aligned with the current execution. And from there, it's on us to create a competitive market and negotiate hard on behalf of our clients. The macroeconomic environment, it's been challenging in our short careers, but we're turning over stones daily, leaning into deals and sponsors that we know can attract this capital. At the end of the day, we're still very early in opportunity zones. With OZ 2.0, we know that has enormous potential to reshape real estate, and we're excited to be at the forefront of it.
Yeah, I think what's been really fun for us is it's a small community in terms of the institutional side, and Jordan and I, not to toot our own horn, but we really feel like we've had quite a positive impact on how they present deals internally to their ICs. Just as an example, we basically, after that exercise in the deal in Boston, where all these variety of OZ pref structures were presented to us, we flew across the country and we actually sat down with them in person and basically had a spreadsheet that showed all the different structures, outlined in one, and said, here's what your competitors are doing, and does that sound interesting to you? And blah blah blah. And then lo and behold, 6 months later, there was a group that tried to source one of these OZ pref structures off market in an off market fashion in a submarket here in New York, and we weren't involved. And eventually the deal kind of fell apart. The sponsor wasn't super educated on how all this stuff worked, and to be honest, the capital partner didn't even really, I think, have a full grasp of what we had maybe initially educated them on. And eventually we got a call from that sponsor, and we're now in closing with a competitor to that capital source on a structure that we had outlined for them previously, and obviously guided and educated the sponsor on the structure that we thought was best fit for that asset. And now here we are a month later, launching another deal in a mid-Atlantic market with a very similar need. And that same capital partner that had approached that other sponsor in an off-market fashion is now looking at putting up a term sheet that exactly mirrors this other deal in New York. And it's like you copy pasted what we educated as to why you got it wrong on the previous deal, right? And so that's fun for us to sort of see. And we've even been hearing, a couple other, deals across the country that, we weren't involved in get done, using structures that we had educated some of these funds on. So, of course, we'd like to be involved in every OZ deal across the country. And I think that we have a pretty good pulse on the transaction activity. I think that Jordan and I were trying to track it and ask some of these OZ funds, but of broker deals, of course, a lot of these funds have their own sponsor relationships that they see deal flow from on a direct basis. But I think of broker deals or deals where there's a capital advisory involved, we're north of 25% of the fund's deal flow. So we're definitely, as in the market as I think we possibly can be.
Yeah, not 100% yet, but that might be tough to achieve. 25%, still pretty darn good. You mentioned, Jordan mentioned at least OZ 2.0 a moment ago, early innings, right? We're recording this in October of 2025. We're about a year away from seeing that OZ 2.0 map and then those new zones, and the full effect of OZ 2.0 will become applicable starting on January 1, 2027. So we're really just ramping up for OZ 2.0. How do you expect institutional capital behavior to evolve in the new OZ 2.0 environment? And what should sponsors and investors watch for in that next wave of OZ deals that'll be hitting the ground running probably second half of 2026 when they start raising funds for them?
I mean, I think the number one thing is the track map for now. Understanding, the markets, the step up in basis. And then to your point, fundraising in the second half of 2026, a lot of the groups have already started on that front from a lot of the conversations we've had. So, we've been staying at the forefront of it, having the conversations and eager to learn more.
Yeah. And I think, you have to track the broader private markets and the public markets, pretty closely, I think, to understand how capital raising is going to go for OZ 2.0. Like, obviously everything comes from a capital gain event and then gets rolled into a quaff. So, a lot of this is going to be dependent upon how successful the existing funds are raising for new fund vehicles for OZ 2.0. Our take is, based off of early conversations, that they will be very successful because the tax benefits have gotten better. And a lot of them have had great success deploying a lot of this capital. And so now you've got some built up track records, you have a better tax framework, and for all intents and purposes, the public equity markets have been doing pretty darn well. In terms of how that capital will be allocated, in terms of the structuring and the cost of that capital, that's more of a real estate question. And it's going to align with what the long end of the curve and the rate environment does. We're now in a, hopefully a Fed easing moment of time here for the next 6 months. But the market continues to be super volatile from a rate environment. We've been kind of hovering around this low fours on the long end of the curve for quite some time, which feels like it's playable. But there's only so many opportunities out there. And if these funds raise twice the amount of capital that they thought they were going to raise, or twice the amount of capital they raised in their previous fund iteration, they're going to have more money than they know what to do with. And that will eventually lead to supply-demand equation of capital and push folks more towards these common equity structures that are just a bit easier for sponsors to stomach. So that's what
waiting
we're
for that to
for.
happen, though. Over the next 6-12 months, we anticipate it looking no different than the way that we just outlined on all the different structures. There are a handful of firms that have funds that need to be deployed by the end of this year. So, we're actively hunting for deals that really fit their parameters. But it's, as I said, it's only a handful of groups.
And Jordan, you mentioned a few moments ago that you have to work with sponsors and educate them on these structuring complexities. These aren't really super obvious, easy things to understand. You guys bring in this new type of structure. It's all about forming relationships. What have you noticed from sponsors in terms of what some of their biggest misconceptions about OZ
Well, I think
structuring
number one,
is?
it's just been frustration, right? In 20 through 22, it was pretty easy. There's a lot of equity raised, and it was a typical 90-10 type deal. So I think the last couple of years, and why people are leaning more into these structures, is because they've been sitting on their sites. They want to get shovels in the ground. They have GCs that are hungry. And it's really been educating them on all the different structures and creating market. And through creating a market, we've seen investors get pretty competitive because they're eager to put out dollars. Again, it still requires a lot of equity coming to the table, but our job is to educate those sponsors. And as I also mentioned, it's turning over a lot of stones, and these structurings are not for everyone. So it's really finding the right sponsors that could lean into this, raise capital around it, and get projects under construction when very few are.
Very good. Well, gentlemen, it's been a pleasure speaking with both of you today. We're just about out of time. Before we go, where can our audience go if they're interested in learning more about Ackman-Ziff and some of these creative OZ structuring options that you provide?
Well, so Jordan and I put together a white paper that you can post on your website, Jimmy, if anyone wants to find it. Of course, on our LinkedIn page, we post all of our deal closings. We have a website. You can email us at arudy@ackmanziff.com or jbrustein@ackmanziff.com. And of course, just LinkedIn in general is a great place to start.
Very good. I will be sure to link to that white paper on the show notes for today's episode. Listeners and viewers out there, if you enjoyed this episode, give us a thumbs up, hit that like button. We're going to have show notes, as I mentioned, available on our website at opportunityzones.com/podcast if you want to read more about today's show and download that white paper. And we'll link to Ackman-Ziff's LinkedIn page as well as their website. Please be sure to subscribe to us on YouTube or your favorite podcast listening app to always get the latest episodes from us. Jordan and Andrew, again, it's been a pleasure. Thanks so much for joining me today.
Jamie, thank
Thanks
you.
so much,
And
Jimmy.
thanks for everything that you do in the space.